Kath. I'm Daniel.
And I'm Mira.
So usually, when you look at the market at the end of the day, the closing numbers give you this pretty neat summary of what happened.
Right. It's usually pretty clean. Yeah. Very mathematical.
Exactly. But today's market, it was an absolute masterclass in why you have to look under the hood to see the real machinery at work.
Oh, for sure. The surface looks remarkably calm for equities, but the undercurrents dragging those numbers around are just moving at breakneck speed.
Yeah, we saw this bizarre, almost poetic divergence today. The S&P 500 went on this massive, volatile intraday ride, right? Only to end up exactly where it started, completely flat.
Which is wild.
It is. And meanwhile, crude oil took a historic nosedive because, that 100-day geopolitical standoff at the Strait of Hormuz finally officially unwound.
Yeah, the contrast there is just staggering.
So our mission today is to take our massive stack of sources, the latest market reports, overnight geopolitical wires, central bank statements, and really just extract the underlying logic.
Right, because we aren't just reading the news to you. We're trying to figure out the baseline you're operating against as an investor.
Exactly. So here is the roadmap for what you're going to get from our deep dive today. We'll explore that dramatic U.S.-Iran diplomatic deal that just shattered oil prices.
Huge story.
Definitely. Then we'll look at the massive tug of war happening during U.S. trading hours between cheap crude on one side and hawkish central banks on the other.
Always a fun battle.
Always. And finally, we'll unpack a massive reality check for defense contractors, even as the AI sector continues to basically, print money.
It's a packed day. But before we dive in, just a quick mandatory disclaimer. This deep dive is for market context and discussion only.
Right.
It is not personal investment advice, and it is definitely not an investment recommendation.
Perfect. That brings us to our first core session of the day, Session 1, what set the stage before the U.S. session.
Right. So to understand today's market action, you really have to rewind to the weekend.
Yeah, we had this massive geopolitical relief valve open up in Switzerland, right?
Exactly. Building on the momentum from the peace talks we discussed in our prior session, reports hit the wire confirming solid progress on a deconfliction mechanism.
And the goal there was to reopen the Strait of Hormuz, which they actually achieved.
They did. At 4:17 p.m. Eastern Time on Sunday, things were looking solid. And then the real catalyst hit Monday morning, just before the U.S. cash opened.
This was the Treasury announcement, right?
Yeah. At 9:12 a.m. Eastern Time, the U.S. Treasury Department issued a sweeping general license. And, they didn't just ease a few sanctions.
No, they went all in.
They fully authorized the production, delivery, and sale of Iranian crude oil and petrochemical products. And that's all the way through August 21st, 2026.
Wow. So that brings millions of barrels of physical oil right back into the global supply curve at near market prices.
Exactly.
When you look at energy prices as a consumer tax, this diplomatic deal is essentially a massive tax cut for the entire global economy.
That's a great way to put it. It's an incredible relief valve for input costs, freight costs, everyday consumer spending, all of it.
But of course, as that relief valve opened in the Middle East, we saw friction instantly escalate over in Asia.
Yeah, we really did. Overnight, at 2 p.m. Eastern Time on Sunday, China's Finance and Commerce Ministries announced immediate procurement bans.
Targeting, 46 U.S. firms?
46, exactly. Essentially, they barred any government-affiliated buyers from acquiring products for these specific American companies.
Which is massive on its own.
Right. But they didn't stop there. They also added 10 U.S. entities to an export control list, halting the shipment of dual-use items entirely.
Okay, let's unpack that mechanism for a second, because dual-use items, it sounds like bureaucratic jargon.
It totally does.
But it's actually the core of the global tech trade, right? A dual-use item is a component, say, a specific type of microchip or a sensor that can be used in a commercial product like a smartphone, but also has potential military applications.
Exactly. And by halting those shipments entirely, China is basically forcing U.S. firms to abruptly restructure their global supply chains.
A U.S. tech firm operating in that region suddenly finds a massive percentage of its revenue just wiped out overnight.
Yeah, wiped out. They explicitly cited national security duties, but functionally. This is a profound acceleration in global supply chain fragmentation.
The frictionless global trade era is kind of fracturing right in front of it.
It really is.
Yeah.
So we have massive energy relief violently colliding with escalating technology and trade friction.
And if that wasn't enough to digest before the opening bell, major political and policy shockwaves began rolling in from Europe.
Right. Early Monday morning at 4:30 a.m. Eastern Time, UK Prime Minister Keir Starmer abruptly resigned outside Downing Street.
Just putting an end to all those weekend rumors.
Yep, and it immediately triggered a Labour Party leadership race with Andy Burnham stepping forward.
You know, a sudden vacuum in G7 leadership is a major destabilizing factor, especially when global markets are looking for, like, unified policy responses.
Very true. But honestly, the bigger shockwave for the markets actually came from the European Central Bank.
Oh, yeah, Lagarde's speech.
Right. At 9 a.m. Eastern Time on Monday, ECB President Christine Lagarde delivered a remarkably stark warning.
She highlighted the upside risks to inflation due to recent geopolitical shocks, right?
She did, but her most critical point was a warning about the observed loss of short-term inflation anchoring across the Eurozone.
De-anchoring. Man, that is the absolute nightmare scenario for any central banker. Let's dig into why that specific word terrifies policymakers.
Let's do it.
Because the entire system relies on the psychological anchor of the central bank's credibility. If consumers start to believe that things will be significantly more expensive next month, well, they rush out to buy those goods today.
Which, ironically, creates a surge in demand that drives prices up today.
Exactly. And it happens on the corporate side, too.
Right. Businesses preemptively raise prices now to protect their profit margins, assuming raw materials will cost more later.
And once that psychological loop begins, it is incredibly difficult to break. It forces central banks to keep interest rates punishingly high to just, choke off that demand.
Which brings us back to that core concept we monitor. Discount rates as financial gravity.
Yes.
Lagarde's hawkish tone severely suppressed any lingering hopes across the market for an aggressive global rate-cutting cycle.
To briefly wrap up this first session, the morning setup was defined by a massive geopolitical relief rally in energy markets, violently colliding with tight central bank policy and escalating trade friction with China. We'll take a short break here.
Welcome back. Session 2. What moved markets during U.S. trading hours?
So when the opening bell rang, the market action perfectly reflected that collision of narratives we just talked about. It was an absolute tug of war.
It really was. Walk us through the equity futures.
Yeah, so the S&P 500 futures contract, ES equals F, opened at 7,543.25. It initially surged to an intraday high of 7,599.25 as equity investors, digested the benefits of cheap oil.
Right, riding that high.
But then the gravity of those hawkish central bank comments took over, and the index gave it all back, closing essentially flat at 7,541.00.
While equities were just churning in place, the U.S. dollar index climbed steadily throughout the session to close at 101.01.
And that safe haven demand, combined with the realization that rates are staying high, pushed the 10-year Treasury note yield up to 4.509%.
And then there's the main event, right? The absolute capitulation in the oil market.
Oh, it was wild. WTI crude, ticker CL equals F, plummeted from a $78 open down to an extreme low of $73.24.
Wow.
Yeah, before finally settling at $74.09. That is a violent, immediate repricing of global risk.
It is. But Daniel, I want to push back on the narrative that this U.S.-Iran deal is a neat, perfectly tied bow. Okay, lay it on me.
Even with this memorandum of understanding to open the Strait of Hormuz, we saw some very concerning headlines regarding Lebanon during the U.S. session.
Ah, right. At 9:29 a.m. Eastern Time.
Yes. Israeli Prime Minister Benjamin Netanyahu and Defense Minister Israel Katz firmly committed to maintaining their military presence and full freedom of action in southern Lebanon. They're flatly refusing to withdraw IDF troops, despite the broader U.S.-Iran de-escalation framework.
Exactly.
But wait, I have to challenge this. If one side refuses to withdraw troops, doesn't that deal a fatal blow to the entire peace process? I mean, the market priced in peace today, but this hardline stance feels like a massive unresolved risk.
I get why it feels that way. It is a risk. But if you evaluate the situation through a game theoretic lens, it makes total sense.
How so?
Holding the Lebanon front provides Israel with critical leverage while the U.S. and Iran hash out the granular details of their 60-day negotiation window.
Ah. Okay, so giving up that physical buffer zone now, before Iran makes concrete, verifiable concessions on their end, that would drastically reduce Israel's negotiating power.
Precisely. This is a classic example of geopolitical brinkmanship as bargaining leverage. It keeps a permanent bid under safe haven assets, but it doesn't mean the broader Hormuz deal is dead.
Okay, that is a crucial distinction. It's leverage, not a deal breaker.
Right.
But, while we're talking about physical buffers, there was another major data point drop during the U.S. session that drastically changes how far these energy prices can actually fall.
Oh, the EIA inventory report.
Yes. At 12:18 p.m. Eastern Time, the agency reported that the U.S. Strategic Petroleum Reserve fell by 8.9 million barrels.
And the reserve is now sitting at 340.3 million barrels, which is the lowest aggregate inventory level we've seen since 1983.
1983. Let's explore the mechanics of why that matters to a trader looking at a screen today. The SPR is designed to be the nation's shock absorber, right? But a severely depleted buffer like this establishes a hard structural floor under energy prices.
The physical market knows that the U.S. government has drastically reduced its capacity to absorb future physical supply shocks.
Right. If a pipeline goes down tomorrow or a hurricane wipes out refining capacity, the government just cannot easily flood the market with millions of barrels to stabilize prices.
So regardless of the near-term relief from the Strait of Hormuz reopening, traders are naturally going to bake a risk premium back into the baseline price of crude.
Because that emergency safety net is practically gone.
Yep. So to summarize our second session, U.S. trading hours were completely defined by investors struggling to balance the consumer benefits of plummeting oil against the gravity of hawkish interest rates.
All while keeping one eye on a heavily depleted oil reserve and underlying proxy war tensions. We'll take one more short break.
Welcome back. Session 3. What is our corporate events recap and what should we watch next?
Let's start with the technology sector, because the narrative surrounding artificial intelligence received massive validation today.
It really did.
So, occurring before U.S. trading hours at 8:11 a.m. Eastern Time, SpaceX successfully kicked off a debut U.S. dollar high-grade bond offering.
Raising fresh capital.
Exactly. And they immediately deployed it. They signed this massive computing power deal worth up to $6.3 billion with an open source AI startup called Reflection.
Which is huge. That agreement grants SpaceX immediate access to highly coveted NVIDIA DB300 chips.
And then literally moments later at 8:13 a.m. Eastern Time, White House senior advisor Kevin Hassett was at the podium publicly touting the sector.
Right. He flat out stated that AI companies are printing money and that tangible profits are materializing everywhere across the industry ecosystem.
What fascinates me here is how immune this infrastructure spending seems to be from the rest of the macroeconomic picture.
It's totally disconnected.
You have hawkish central banks threatening higher rates, you have a fragmented supply chain in Asia, and yet these mega cap companies are still deploying billions of dollars into computing power.
We talk about AI capex as a cycle-agnostic arms race, and today just proved that thesis is completely intact.
Yeah, the capital expenditure is entirely detached from the typical business cycle because the perceived cost of falling behind in AI is simply too great.
But, while the tech sector is flying high and printing money, the defense sector received a massive, sobering reality check during U.S. trading hours.
Oh man, did they ever. At 1:21 p.m. Eastern Time, Donald Trump summoned the chief executives from major defense contractors.
We're talking Lockheed Martin, Boeing, RTX.
Right, and he demanded a significant boost in munitions production. Now, on paper, if you are a defense contractor, more government orders should mean more revenue.
Usually, yes.
But there was a massive catch attached to this demand.
He explicitly stated that stock buybacks would no longer be allowed for these companies.
Wait, like at all?
At all. The administration's intentions to force these contractors to reinvest their free cash flow back into physical manufacturing facilities rather than enriching shareholders.
Wow. And if you're holding defense equities, you need to understand how this fundamentally fractures the capital allocation model of the entire sector.
It really does. A lot of investors hold defense stocks specifically for predictable dividends and share repurchases.
Because a stock buyback artificially reduces the total number of shares available, right? Which boosts the earnings per share, driving the stock price up.
Exactly. By banning buybacks, the administration is forcing that free cash flow to be diverted into capital expenditures.
Building a new munitions factory is great for the national defense industrial base, and it might pay off in a decade. But Wall Street evaluates stocks on quarterly capital returns.
Right. Banning buybacks penalizes the equity investor today, which is why those valuation models are being violently repriced.
Well, folks, the closing bell has rung on a day where the S&P 500 ended just about as flat as it started.
True.
Crude oil took such a violent nosedive after the U.S.-Iran Hormuz deal that it might soon be shorter-lived than Keir Starmer's time at Downing Street.
Right.
Meanwhile, the White House says AI companies are printing money, which is lucky since Trump just summoned defense contractors to ban their stock buybacks. So if your portfolio feels a little stagnant today, just be glad you aren't an oil bull trying to submit your resume for UK Prime Minister.
Very true. A truly chaotic landscape to navigate today.
So looking ahead, what do we need to watch next?
The incoming 24-hour calendar for Tuesday, June 23rd is packed. We have the ADP employment change report at 8:15 a.m. Eastern Time.
Okay.
And then shortly after the open, at 9:45 a.m. Eastern Time, the S&P Global U.S. Flash PMIs drop, covering manufacturing, services, and composite data.
That is always a crucial temperature check on the real economy.
Followed closely by the Richmond Fed Manufacturing Index at 10 a.m. Eastern Time.
Plus the bond market stuff, right?
Right. You also have to keep an eye on the U.S. 6-week Treasury option and the 2-year Treasury note auction happening midday.
Got it. Now, I want to leave you with a final provocative thought to chew on tonight.
Let's hear it.
We are seeing these massive multi-billion-dollar deployments in AI infrastructure, and the White House is boldly declaring that AI companies are printing money.
Right.
But at the exact same time, central banks like the ECB are actively struggling to re-anchor short-term inflation expectations.
Lots of tension.
It is. This raises a crucial question you have to ask yourself as an investor. Is the AI CapEx supercycle, with its insatiable, price-agnostic demand for power, land, and silicon chips, actually contributing to the very sticky inflation that is keeping interest rates painfully high for everyone else?
It's a great question, and we'd love to hear where you all land on that. So please share your thoughts down in the comments.